welcome to all of you. I am accompanied by Steve Cecchetti, the BIS Economic Advisor and the head of the Monetary and Economic Department of the BIS. And before Steve and I take your questions, I would like to make a brief introduction. This year's BIS annual report focuses on the legacy of the financial crisis. The exceptional measures taken worldwide over the past 2 years succeeded in preventing a financial system meltdown and in bringing to an end the great contraction in global economic activity. Policy challenges today are not less daunting than they were a year ago. The room for maneuver for macroeconomic policy has narrowed. Most advanced economies are reaching the limits of fiscal expansion, and the essential task of reducing leverage and repairing balance sheet is not finished. Extraordinary measures seek to help an orderly adjustment, but we must recognize that some of them are delaying the necessary changes. Steering economic policy in such circumstances requires a delicate balance. A well-articulated medium-term perspective is needed to guide all policies, including those aimed at supporting a still fragile recovery and keeping the financial system operating. Policymakers have to foster adjustment in the financial sector and the development of a less credit-dependent growth model. The specific policy measures that are needed will vary according to the different circumstances in each country. The scale of the fiscal problems and the strength of the local banking system differ across countries, so there is a single policy prescription for all. But we underline on this annual report 3 broad policy challenges. First, the need of a convincing start to reducing fiscal deficits in advanced economies. In many countries, growth can no longer be sustained by fiscal expansion, and front-loaded fiscal consolidation is required. Recent announcement of fiscal consolidation plans and targets by a number of countries are therefore welcome. The alternative of having to cope with the financial and macroeconomic disruption from a sudden loss of market confidence would be far worse. Over the past year, growth in many emerging market economies has recovered strongly. This has helped to improve global demand conditions, but inflation and capital inflow pressures in many of these emerging economies are raising difficult policy dilemmas. A more flexible exchange rate could help relieve inflation pressure in some countries, as well as promote a more balanced global growth. The second challenge is that authorities must foster the necessary strengthening of balance sheets in the financial sector. This is the precondition for restoring financial stability and scaling back public sector involvement in financial intermediation. Banks have raised new equity capital, but some may still not be well positioned to the losses and risks that may lie ahead. In addition, some banks have not yet made transparent the scale of losses already on their balance sheets and remain too dependent of very short-term borrowing. Exceptional government and central bank support was needed to quell the enormous uncertainty and market disruption during the crisis, but keeping support measures in place over a long period creates moral hazard, and the public sector must actively promote adjustment to a more stable financial system. The third is we need to finalize the international agreements on the reform for financial regulation. A coherent global financial stability framework is a precondition for a safer, more resilient financial system, and it is therefore very encouraging that the Financial Stability Board and other standard setters have made considerable progress on this reform agenda. Action is required in several fronts. We need more and better capital and liquidity buffers to make banks substantially more resilient. We must also reduce the moral hazard associated with the too big to fail issue, and the systemic dimension of financial risks need to become tightly woven into the new regulatory and supervisory fabric. The Basel Committee is well advanced in its preparation of regulatory reforms addressing the core elements of bank soundness, capital, liquidity, and leverage. The committee's reforms are being prepared in consultation with the industry, and the measures are undergoing a rigorous quantitative testing, including a macroeconomic impact study. A sustained global recovery requires a stable and resilient financial system. The long-term benefits of lowering the probability and cost of financial crisis are substantial, and the reforms will quickly generate significant benefits from enhanced resilience. The new regulations need to be phased in a way that is compatible with the ongoing recovery, and according to preliminary estimates, the net impact on global output during the phase-in of the new regulatory regime is likely to be small and transitory. Finally, the role of macroeconomic stabilization policy, that is monetary and fiscal policy, and ensuring financial stability must be recognized. And sustainable high fiscal deficits can quickly destabilize financial markets, and long periods of extreme low policy rates give rise to financial stability risks. This means that in order to play their financial stability role effectively, central banks need realistic financial stability objectives and effective tools that are consistent with their monetary policy responsibilities. Let me conclude. In today's fragile economic and financial environment, rebuilding confidence is an enormous challenge. We cannot wait for a stronger global growth to facilitate policy adjustment. Credible actions for meaningful fiscal adjustment and for restructuring the financial system would boost confidence. Finalizing international agreements on regulatory reform according to the schedule will reduce uncertainty and also send a positive signal not only to markets but also to the public at large. Let me finalize saying that recent announcements, policy measures announced, represent a significant step in the right direction. Fiscal consolidation in some countries, for example, the publication of the stress test results for the European banks that has been announced, and also the support of the G20, recent support of G20 for the regulatory reform agenda are all important step forward. Thank you very much. We are at your disposal for questions. Please.
Yeah, my name is Torsten Rieger. I'm with Germany's Business Daily, Handelsblatt. I have three questions. First of all, you came out clearly for fiscal consolidation as a first priority or top priority at the moment. So what's the role for monetary policy at the moment? Is there a complementary role could wait a little bit more tightening monetary policy when fiscal policy goes ahead with consolidation? Second question is, what about the efforts by the banks at the moment painting a picture that when we implement the financial reforms, there will be a downside on the growth side. You know the scenario given by the IIF that we will face losses of jobs and clearly less economic growth. Third question, stress test. You mentioned the stress test, the publication of the stress test in a couple of weeks or so. I just wonder, do you think this picture is complete? Do we need a step more in regards to recapitalization of banks? So do you have any indications that that will happen in the near term? Thank you.
Thank you. First question was on fiscal consolidation and the role of monetary policy. I think the role of the monetary policy continues to be to pay attention to the risks on financials, to the risk of price stability. And it is clear that a process of fiscal consolidation will give more room for maneuver to the monetary policy. But there are a number of caveats. First, it's necessary to see how fiscal consolidation translate into growth and expectations. It may be the case, and this is something that we need to see, that fiscal consolidation could create additional confidence and that could be positive. So we need, monetary policy has to be attentive to that. The second caveat that we think is important to take into account is that monetary policy has to look into price stability, and of course there is now room for maneuver. We know that there is a slack in the economy, and this is there, and fiscal consolidation may accentuate that a little bit. But we also, and that's part of the message that is in the annual report, monetary policy has to have perhaps a little bit longer term outlook and look also to the financial stability consequences of low interest rates. This is not an easy task, but this has also to be taken into consideration by the monetary policy authorities. So it is important that the monetary authorities are looking forward with a time scenario that is a little bit longer than the usual price stability scenario, to look into the potential problems coming from financial instability that could come for a too long period of low interest rates. Now, the second question was the estimates that banks have about the potential downside problems of the regulation. I would like to say that here the key element from my point of view is that the Basel Committee and the Financial Stability Board has set up a very, I would say, sound process on how to take these decisions. And the sound process involves consultation with the industry that they have done. They have all the data about with the QIS and further consultation, and a process of doing all these scenarios, macroeconomic impact scenarios, to really determine what are the potential impact. And this is still work going on, and it's a very substantive piece of work that involves different approaches, so that it is very well captured what is the potential cost. The early estimates that we are having indicate that this is low and it is temporary. And it will be when this is fully terminated and discussed at the Basel Committee and at the Financial Stability Board, when the results will be published, and then probably it will be a possibility to enter into more details. But I would emphasize that there is a quite good process that is being done, and that it will be, at the end of the process, it will be the right decisions for the calibration and for the reform. And it doesn't seem to indicate that, on the contrary, if you look at the benefits of not having this kind of crisis and reducing the probability of the crisis are particularly significant. And the benefits of being resilient in the financial system, particularly when the road is very bumpy as we have now, it is quite significant too. But this is something that the Basel Committee and the FSB will be able to provide with much more detail down the road when they discuss these elements. Finally, on the stress tests, I think the stress tests provide with a number of good features. One is transparency. There are some uncertainty about balance sheets and about the situation of the banks. I think the first benefit will be to provide transparency. So it's very important that the stress tests are stressful, that the methodology, the assumptions are published, and obviously the results. That will provide a lot of transparency to the situation. They should be obviously forward-looking. That's what it is meaning. And if when the stress tests point to the need to take actions, it will be necessary then to take the actions. Hopefully the market can do it. If not, it will be the authorities that will have to step in and help if some of the banks are viable and need some kind of support. Yes? Please, Mike here.
I'm sorry, Mr.
Sorry.
Caruana, I have the Feo Corriere della Sera. I have an additional question to what you just said. What do you mean exactly by the authority would have to step in? Are you thinking of and speaking with the countries to make obligatory to recapitalize?
No, I think it's for them to decide on these issues. I will not enter on what are the measures they have to take. They will have to have the dialogue with the banks and decide on what to do. But obviously, the stress test, implicit on the stress test, is that when problems are detected, there will be measures to address them. There are plenty of measures, and it will be for the supervisory authorities to act. Yeah, please. I mean, sorry, the mic is not moving fast, but go ahead.
In the front.
The front.
In the front.
The front. There is a request. Yeah. No, but go ahead, please.
Okay, Jack Ewing from the International Herald Tribune. It appears after the G20 meeting yesterday that the timetable for the reforms has been pushed back. I just wondered if you have any comment on that. Secondly, I'm wondering how much the annual report, the statements there, and also the statements that you've just made, how much does that represent a consensus among the BIS board? And then finally, I just wondered if you could give us a little bit of a flavor of what has been discussed today and if there were any other major decisions or topics.
Well, on the G20, the only thing that I read there is really a significant support to the work and to the agenda and to the need to complete the reform with the schedule, with the agreed schedule. So what I've seen is a very strong support on the regulatory agenda and explicit support to the FSB and the Basel Committee. So what I see there is support. And I think on the need to move ahead and to take to complete the reform this year, it's a full consensus that this is needed to be done. So I would differentiate two things. One is the need to have a clear sense of where we are going, what are the rules that there will be in a steady state, and the other thing is a transition that it will have to be decided on the basis of being consistent with the recovery, with the still weak recovery. But in terms of deciding this year what are the rules of the steady state, I think there is a consensus that this is absolutely needed. This will reduce the regulatory uncertainty, and this will help also. And I think these were the two questions, yeah. Please.
Yeah, Pickard's Wirtschaftswoche from Frankfurt. Mr. Caruana, two questions. One, again, on the G20. How would you assess the general or the final agreement on consolidation in terms of halving the deficit by 2013 via a growth-friendly fiscal consolidation? How realistic is that? First question. And second one, again, on monetary policy, to both of you. The report is more than 10 pages on the risks of low interest rates, global interest rates, which seems to me a bit more than just saying the central bankers have to look forward in the medium term concerning their monetary policy and interest rates there. And so what would you a bit more precisely recommend the central bankers in the next months and next year to come? I mean, the report clearly says raise interest rates. Thank you.
Well, first, on the first question, and then I will ask Steve to continue on both questions. But on the first question, I think the G20 is talking about a balance. And if you look what we are saying that some countries need to be front-loaded in their fiscal reform. So in a more broader context of the G20, and we were talking more on advanced countries, some kind of balance is necessary. It is true that we are saying that in our view it is the risks of not moving rapidly in the fiscal consolidation are high, and that when there is a problem and we have started to see some of the materialization of these problems of confidence, it is difficult to just to try to smooth by fiscal deficits. So we are, yes, advocating for a rapid process of consolidation as a way of generating confidence that would help in the growth process. And probably you want to add something.
Yeah, I mean, I think on this, I think what the main point that we're trying to make here is that there's an issue of ensuring that fiscal policies are on a sustainable path in the long run. And different countries are at different points right now. Different countries have different room for maneuver. Different countries are different distances away from the limits. But in many cases, the issue is what happens out 10, 20, 30 years. And much of what we're saying is that you need to make structural adjustments, and those adjustments need to be growth-friendly adjustments. On monetary policy.
No, the growth-friendly comes. I mean, it's always difficult to know what is going to be the result, but to try. I mean, it's the alternative of not generating confidence may be even worse, and I think that's where the difficulty starts. We think that moving forward, something that is credible, but it is front-loaded, will generate the credibility to reduce some of the problems of confidence that we have started to see. I mean, it's not just market confidence, it's also consumer confidence in the sense, and investor confidence. It's the question of raising very rapidly saving rates or not investing, waiting because of the uncertainties. So I think that it is much broader than just the market dimension. On monetary policy, the message is you have to monitor also financial stability. That's the message. It's not a message saying that something should be happening now. This is not what you should read. What we are saying is you have to look at the financial issues. If you look at the financial issues, it may happen that you may need to raise rates before your comfort zone, looking just at the macroeconomy. That is what we are saying. So this is the lesson of the past, and we continue. This is not the first time that the BIS is saying that we have to pay attention to financial stability, and we continue to say so.
I mean, I think just to add to that, we've been making a point for a while that what we're advocating is a financial stability framework that's broadly construed, that has a number of different elements that contribute to financial and macroeconomic stability simultaneously. And those involve not just regulatory reform and regulatory and supervisory policies, but also fiscal policies that ensure that countries' debts are on sustainable paths, and monetary policies that appropriately take into account a broad array of financial conditions, as well as ensuring price stability.
In my initial remarks, we mentioned a little bit of some of the issues that having low rates generate. Any question? Additional question?
Thank you. Patricia Döhler from German magazine Brand 1. I have two questions. The first one is on the topic of confidence. You've repeatedly said how important confidence is for financial markets. Now, the reaction of the IIF to the suggestions of the Basel Committee sounds as if, the banks were really convinced that new capital requirements would really hinder growth. And it almost sounds like a threat. So, how does that make you confident that the banks eventually are going to support financial regulation? And the second question is, in your report, you're writing that the banks should look for a new business model, trying to reduce the risks they're taking and make their income stream more stable. Now, do you have the feeling or the impression that the banks are moving towards that direction already? Thank you.
On the first one, again, what I can say is that the process is a solid process, and it involves discussing the elements with the private banks, and that preliminary results do not point into a growth problem coming from the regulation. On the contrary, it would support resilience relatively rapidly. Of course, the process ends up in the Basel Committee deciding on the adjustment that need to be done to the framework according to all the information that is being gathered, and this is what it is happening during these days until the next meeting that will happen in mid-July. So the process is still alive, and the dialogue continues to be there. I think banks are taking measures, but I think they probably need to think more in terms of how to, in this difficult environment in which still there are risks out there, how to better improve governance, how to better manage risks, and how to conserve capital more efficiently until the stability of the financial system is restored. That is what I think they would need to do. And on the funding side, I think the incentives of the low interest rates is, for example, to shorten the maturities. And I think it is also very important that they move into a sounder, more balanced funding patterns that would provide additional stability to the financial system. So there are a number of things. And obviously, in this kind of presentations, we tend to kind of talk about averages, but the situation varies from bank to bank. Some banks are doing more, some banks are not doing more, I think, and are not doing so much. So I think the key issue of the stress test would be to have a better picture, and this would encourage also for them to take actions in the right direction. There is one question there and another there. Okay.
Yves Genier from the newspaper Le Temps in Geneva. Going back to the G20 meeting in Toronto last weekend, the leaders played down the idea of introducing a global taxation of banks. How do you comment that?
Well, from our point of view, taxation has different angles and different rationale. One of the rationale is related to more fair distribution of the costs of the crisis, and on that we have little to say. I mean, it is for the tax authorities to decide what is better from that perspective. Getting revenues because there has been a substantial increase in deficit because of the crisis. This is an area where it's for the authorities, for the national authorities. We comment perhaps more on the other side of the taxes, which is the financial side, trying to correct some of the incentives. Obviously, taxes can correct incentives, but we think that it is much more efficient to do it through capital and through this other regulation than doing it through taxes. But of course, this is for the national authorities. At the international level, I think it is important to distinguish those reforms that, in our view, are the key core reforms, which is capital, which is liquidity, which is the too big to fail associated issues, these kind of things, which are the core of the reform, and other measures that can be taken by countries where probably the degree of uniformity among countries will be much less. And I think in this category is the taxes. Some countries may decide on the taxes. Obviously, it's not the same if you have had to put a lot of money to restore financial stability in some countries where there has not been the need for that. So it is a much more complex issue that depends on the national specificities, and therefore it is less likely that there will be, and that's what you were reflecting, that there will be more a unified approach on that. What it is important is on the core of the reform, which is capital, which is liquidity, which is the other elements of the too big to fail. On that is very important that the degree of application and the degree of uniformity in the rules is much higher, and that's the role of the Financial Stability Board and the Basel Committee. Yep.
Kranenberg, Financiële Dagblad from the Netherlands. In your speech you delivered this morning, you say official budget forecasts could be prepared or verified by independent agencies. Is that remark inspired by what happened in Greece, and could you specify a little bit?
The remark is a general remark. We were saying that it is important to consolidate and that the credibility of the consolidation is important, and credibility is gained by basically a couple of things. One, starting to act, and second, that is the front-loaded component that we have repeated, and the second, we also said that by improving or enhancing some of the structures, in some of the, what's the word, enhancing some of these elements, there are elements that can enhance the credibility, such as, for example, the one that we mentioned there, the fact that there will be some independent overview of the forecast, or that there are legal requirements that set some hard limits on debt or on, for example, deficits. What we were saying is that in addition to taking the deficits, it would be, and it depends on the country. We are not making one rule for everybody, but it depends on depending on the country, they could reinforce. There are ways to reinforce the credibility of the measures if they take this kind of structural measures that are aimed to increase the credibility by, to some extent, giving some authority to independent bodies, or by having this additional legal framework that would make them much more difficult to increase deficits or increase debt. So that was what we meant.
The back.
Yep. At the back.
Sheila Mathrani, The Economic Times, India. You stress a lot on EMEs, and they say they're in the danger of overheating. What do you mean by that? And then you also propose that it's necessary for EMEs and advanced economies to continue working together. But since they are on different levels, how do you expect them to come together?
Okay.
And the third thing is also because of the headline inflation rates. They are rising a lot in India. For example, it's over 16%. So would you think that by increasing the interest rates, it would be the best solution?
Okay. Well, I will not enter into policies of specific countries. So, but in terms of what we say in the annual report, and I will ask Steve to complement what I say, is that the emerging markets are at the same time that in the advanced economies, the recovery is weaker in the emerging markets. It has been significantly stronger, and it has been accompanied by these inflows, significant inflows, and in some cases this is creating these challenges, important challenges for policymakers. And there are a number, and I would say that part of the work that has been done and part of the work of working together that I was mentioning is to realize what are the policies that they have available. And particularly in the case of Asia, in the case of India, they have been using not only interest rate, they have been using also macroprudential policies. They did take some measures in terms of raising, for example, capital standards and prudential standards. We think that it is the combination of interest rates, which should not be forgotten, and macroprudential that could help emerging markets to cope with this kind of pressures that they are having. They are having, in some cases, inflationary pressures, as you were saying. It is important, the coordination in any case, and the discussion that they have together, for example, here at the BIS, among the different central banks. To analyze and to understand what is the situation in the different countries. This is important, and then it's important to have the tools. And again, part of the work that we have all been doing is to complement the tools, the traditional monetary policy tools, such as interest rates, with these macroprudential tools that help in some cases. I don't know, you want to complement?
No, I mean, should I say something? I mean, I can say what I will say is that I think that the first thing is that that many emerging market countries, as we look around the world, have what I would say is a rather enviable problem relative to the problem of the advanced economies, which is to say that their problem is that they are growing at a very healthy rate. That their financial systems did not suffer as a consequence of the crisis because they were resilient by and large going into this. But at the same time, I think that we have to accept that there were a number of causes of the crisis in the first place, and one of those causes included imbalances that existed in the world in which the emerging market countries were clearly a part. And so on the first issue of overheating, I think this is just a point about taking care. Policy decisions are almost always very finely balanced, and I think, though, in the emerging world they're a bit different. They're balanced in a slightly different place than they are in the advanced economies. On cooperation, I think that this is just a comment that if we don't redress some of the problems that brought us to the crisis in the first place, that we will regret that eventually, and that involves the whole global system, not just one part of it.
Yeah, I would like to follow up on this point of international cooperation. A year ago, you came very much out in favor of international cooperation. Now you are stressing different circumstances in different countries and so on. So I just wonder whether there still is a case for international cooperation, or are we at a point where we can say, okay, we need some leadership by example? The financial bill which comes out from the US might be an example. Are we still in need of this financial cooperation on an international basis, or is it much better if a big country, if Europe goes ahead with a transaction tax, the US is going ahead with an own financial bill? So what's your point on that?
No, I think first some leadership is not inconsistent with some cooperation, but we would emphasize very, very much the need for cooperation. I think crises usually tend to and we have to understand, these may be global problems, but it manifests nationally. It manifests in the different nations in a different way. So it generates incentives to take national measures as solutions. And it's very important that the different measures are consistent. And for that, you need this international cooperation. So I think we are in a globalized world. We need global solutions. We need international cooperation. And what it is important is that there is consistency in, generally speaking, and in some areas. And again, I come to the core of the reforms. In the core of the reforms is more than that. In the core of the reforms, there should be really a common understanding of what are the rules, and then implemented in each of the countries. But if you were talking about the reform in the United States, there are some of the elements of the reform. For example, a very clear macroprudential approach that they have introduced in the reform. This is part of what we have been discussing. This is part of the cooperation that we have been talking about. So it seems to me that the cooperation manifests in the way in which countries are reacting to the crisis, even in their own reforms. They are very supportive of a strong capital and liquidity requirements. So it seems to me that the cooperation is manifesting. It will never be exactly the same in each country, but it seems to me that first it's important, and second, it's working reasonably well.
Yes, again, on this point, I was wondering how long do you judge the window of opportunity we have to complete those reforms? I mean, you just said till the end of the year, and we hope that we might get to result in Korea at the G20. It seems to be less and less realistic that the states really go ahead with this, because more and more points are to be criticized also in those core reforms from various countries. So how big is the window of opportunity we have if we don't manage to come together at the end of the year? How much time do we have yet?
No, I don't agree. I think the reform is already progressing quite rapidly. There are, again, there is a sound process. There are going to be the necessary meetings. The reform will be ready for the Korea meeting. This will be the reform on capital. This will be the reform on liquidity. This will be the reform of the broad agenda that the FSB is working on. A different thing is when this will need to be implemented and what is the phase-in of some of the elements. And this will depend, as it has been very clearly stated, on the consistency with the recovery. And that is something that will have to be also in the process from here to November be clarified and made it clear. But the important thing is that the rules will be known. The rules that we are aiming at the end, in the steady state, will be known at the end of this year, as it has been scheduled. All what I'm hearing is support for the schedule and to get the agreement at the end of this year.
Okay, the support for the schedule, okay, but then the detail of the reforms and if they are sufficient enough. I mean, look at Germany, the Bundesbank is really strongly against a leverage ratio and core things like that.
The details needs to be, the leverage ratio is already agreed. And the question is the calibration of all this. It's a little bit less controversial than you think. It is a question of now, with all the information that the standard setters have, to get the right regulation with all this information, which was always the plan to do. And they have, with all this consultation process and all the data that they have received, they have it's a very, I would say, difficult task. It's not easy, but it is something that it is happening, and they are working very hard. And I think they are all committed to get to a more resilient financial system. I think, I'm convinced it will happen.
Yes, a group of members from the European Parliament has published a letter strongly complaining about lobbyism by the banks trying to stop substantial reforms in the financial system. What is the point of view from the BIS and the Basel Committee? Do you feel the lobbying by the banks, and do you also feel that it's being too strong, or it's being taken too far?
I think that the only way to manage these kind of things is what I said. You have a strong process, you explain how the process is going to work, you do a proper consultation. That means that you listen to what the banks have to say, but with data, with information, and then you process all this information, you work with the supervisors that work with the banks in getting the right approach, and you finally conclude the elements that still are open. And you make a macro impact. In addition to all that, you make the macro impact to make sure that the transition is the appropriate, so that there is no significant impact on growth, and that the impact is small and temporary. That's the process, and the best thing that we can do is to stick to this kind of process that has consultation, and the rest, it is not important. The important is to get the right information through the agreed process that is in train, is working.
Yes, Simone Meyer with Bloomberg. Mr. Caruana, I wondered whether there was a sense that all this excess liquidity and all the unconventional measures are increasing future inflation risks, and also maybe laying the basis for bubbles, and whether there was a sense that maybe central banks at this juncture are not doing enough, actually maybe focusing more on growth and fiscal consolidation rather than future inflation risks. And secondly, you said regarding stress tests that it will be up to markets initially if there's a need for action, and then authorities. I wondered whether you could elaborate a little bit on that. Thank you.
the second.
Okay, I'll take the first one. I think that on the issue of the size of central bank balance sheets and their composition, I think that those things have been done with tremendous care, and that the authorities that are engaging in those in those policies are well aware of the longer term risks associated with the actions that they've taken, but that in the short term, what they've done has been to try and stabilize the financial system in the face of what were really quite significant shocks, and I think that we would all agree that they were very successful in that. The processes of reducing the size of the balance sheets are being put in place, and I think that people are very, very concerned about the potential for inflation going forward, and are looking at that quite carefully. So our concerns, I think, as we say in the annual report, are somewhat different. They're about the behavioral and institutional distortions that are generated by long periods of very low policy rates.
On the second part of the question, that is the stress tests, you see that in our annual report and in the speech, we are talking of the need for the banks to continue with their adjustments. The only thing that I said to introduce here the stress test is that I think that this is a step in the right direction. Now, the details of the stress test and the actions that they are going to do, it will be a question for the authorities, and they will be coming with this kind of announcement when it is the right time. So I would not like to intrude much on that. I think just that it's very consistent. The stress test that has been recently announced, it's very consistent with what we are saying in our annual report. It's a step in the right direction. They will have to clarify how they are going to do it, when they are going to do it, and what are the measures that they are talking. And I'm sure that they will do that.
So if there are no more questions, thank you very much for your attendance.
Thank you.
The press conference on the 80th BIS annual report is now closed.